My name is James Thorson. I am Professor of Economics and Finance at Southern Connecticut State University. I have taught here since 1992. Credit is just getting access to the use of money that you don't currently have. It's a very useful tool to have. However, it has to be used wisely. So financial discipline is very important. Credit is when somebody is lending you money with the expectation you're going to pay back in the future. Credit can be for convenience purposes. If we use credit cards, that's a short-term loan to save us from having to carry cash. Credit score is a measure that tells lenders how creditworthy somebody is, how likely you are to pay off your loan if they lend you money. You can check your credit from the major credit reporting agencies. For example, Experian is one of the major credit agencies. And you go on there, and good news is that there's a free credit check. There's really, at this day and age, no reason to pay money to get your credit checked because the major credit companies will do it for free. Number one, your credit history, how good you are at paying off your loans. Your credit utilization is important. So for example, if I have, let's say, $10,000 available to borrow on my credit cards, if I use less than 30% of that, that's a good sign. If I use too much of that, then lenders start getting a little bit worried that I might get overextended. Let's say you're 25 and you want to buy a house. Well, the first thing that they're going to do is they're going to check your credit. They're going to check your credit score. And so if you have a track record of managing your money well during your young years, you're going to get a much lower interest rate. If you have a credit score that's relatively low, you can still probably borrow money, but they're going to charge you a higher interest rate because if lenders think you're more risky, it's going to result in charging you more money because they have to compensate themselves for the risk that they're taking. It's not likely to have a huge impact on your credit as long as you're managing them well. You know, credit card companies don't get as concerned about having more credit cards as whether or not you have a history of paying off your credit cards on time. One way that you can build credit is by paying your rent on time. So landlords sometimes report information to the credit agencies. They're starting to look at people who have bank accounts. So for example, if you're a young person and you don't have a credit card, if you have a bank account and you have a history of not having overdrafts and that kind of thing, the credit companies now start to look at other things to try to help people that don't have an extensive history get access to credit. An average credit score is about 687. About 740 and 800 is a very good credit score. The very high credit scores are for people that have had credit cards open, let's say, for 10 years and have a good track record to manage them. So it's harder for a young person to get a very high credit score. The number one best way to improve your credit score is to have a history of paying off your credit cards on time. If your credit card has a minimum monthly payment, at least make that every month. Don't have late payments because late payments tend to harm your credit score. The other thing that helps is to have a relatively low credit utilization. So if you have credit cards or loans outstanding, the less you utilize of them, it actually, paradoxically increases your credit score.